Wonderful. It's so nice to thank you for that warm introduction. That bio seems a little bit all over the place with the political economy and the chemistry, but if we somehow made it work, excited to be here with you all again this year. I think what we're going to do is really similar to last year, and so maybe if I can, yeah, I'm allowed to share a screen, then I can show. Let's see here. Just give me one quick second. There we go. And hopefully, I think everyone should be able to see my screen. And so maybe just for those that don't know, Energy Impact Partners, we're just shy of 5 billion under management across 5 strategies that all invest in the energy transition. The way that I like to think about how they differ internally is how we invest in our investment style, which really is a function of commercial and technical readiness. For the techno-economics, I would argue it's important at all different stages. And certainly where I sit as the director of technology, we always start at really at first principles at EIP and on the investment team. And so myself and 2 of my colleagues, one is a chemical engineer and the other is a mechanical engineer, our main job is really to understand the technical limits and sensitivities of any one technology. None of us are fundamentally trained in all the different areas that the investment team does invest in. And so that's been part of the learning curve and the challenge and the opportunity of this role, honestly, at EIP. And so I want to start in really just at the principles of what techno-economics analysis is and why it's important for us. And so at the fundamentals, like what is TEA and how can it help and why do we think it's important? And I should say, certainly on our team, our first principles analysis on the technical team is at the forefront. So across all the different metrics, our main job is really to distill down the 3 to 5 metrics that we think can make or break a TEA. And so our job is not to get PhDs in a bunch of different topics, although that would be really fun. It really is trying to get ramp quickly and understand where the sensitivities and the limits are for that presumably that startup or that technical team behind that startup are focusing on. And so really, what is TEA at the highest level? It's a tool that allows one to assess the value of a particular technology. So it's going to show you what the value of that technology is, and I put it here as a function. So what can your technology do? With the market, so the willingness to pay. You could imagine there's some markets where the willingness to pay could be quite great. So an example of that, I would argue, would be in the sustainable aviation fuel market relatively, while there's other markets where the willingness to pay could be quite less. So being cost competitive, i.e., being competitive with gray technologies or fossil based technologies, is important. Is your technology solving a big pain point, market size? And you want that value and that unique value prop to be obvious in the pitch. And certainly, techno-economics is the way to bring that to the forefront. And really, is that value greater than the cost? And so, when you think of cost, we're thinking of everything that would underpin that from the system design, so the capex and the opex. We're looking, in particular, if it's an electrified technology, on the energy cost and your assumptions around energy pricing and energy markets. And really, as I mentioned, we're trying to distill down the technical metrics that matter and answer a very fundamental question. Is it better and cheaper than the best available technology? And so what we're looking for, and I think oftentimes, and certainly after the team is pretty external facing, and we really love talking about TEA because we think it's that important, not just for us to invest or others to invest, but really it's really at the heart of what we want. Is we want the startups to be successful, and we want these really amazing technologies to be scaled up and commercialized. And so it's important that founders also have this at the forefront of their minds. And it's really awesome from my perspective when I see initially when I'm working with one of our portfolio companies, and it might be that the CTO or CSO are thinking about TEA. And then when you start seeing where culturally it becomes like a mission statement almost, where if you've got a chemist on that's looking at one particular catalyst design, and the framework for which they evaluate technologies is a function of like cost and value. And you start seeing this like this percolate through the organization. It's a really rewarding feeling. And so what we're looking for when we are thinking about TEA is often if you are, a seed, pre-seed, series A company, and you start out at some path, your TEA almost certainly, and like you're at low volume, you have no scaled manufacturing capacity, you're buying your chemicals from Sigma Aldrich, which no knock on Sigma, they're great. I love them as a chemist, but they're not necessarily for bulk chemical pricing. And so you're really at this, you don't have the scale in order potentially and most likely to be economic, depending on what your technology is. And maybe there's a lot of technical de-risking you need to do. And that technical de-risking could be a lever in your model that you aren't there today, but you will be. And so really what we're looking for always is the pathway. So today, as I in my diagram here, is maybe uneconomic, most likely I would say. And really what we're looking through in our diligence process, when we're doing diligence and technical calls with founders, is we're looking at the pathway. So, what is the pathway to go from your techno-economics today to that first of a kind to the nth of a kind? And we know when we're looking at this that your assumptions today or your knowledge today, it may not be what it will be in the future. And so not only are we in discussions with founders, walking through that pathway, we're also, whether it's internally having our own, thoughts around typical technologies and their pathways, or also our advisors, where we're also, vetting ourselves is that pathway credible? Do we believe that we will be able to hit those technical metrics that will make the future technology economic? And really, at the heart of it, it's what I put in this last bullet. It's really, can this technology compete today against the incumbent? If not, how can it? So, what do we need to believe for that technology to reach that? And that's really as a function as a CTO or the head of the technical team setting these targets as the technical or as the tech develops. And so I wanted to give a quick opportunity here on on an example on what this could be. So a very simple example here would be like power to liquids, and I've done a very simple like 10-liner TEA. And I would say, oftentimes people think TEAs need to be multi worksheets, and maybe in the future they are. I would argue at a series A, series B, but definitely at a C, even a good, 10, 20 liner TEA can really show you the metrics that you should be focused on and what the sensitivities are and what's in your control and what's not in your control. If you're a customer of a certain input that's a sensitivity in your model, then you've got to have belief on that and will also come down the cost curve. And so here I'm showing the production of methanol. So on the left, the problem statement is there that methanol is 170 million tons of fossil-based methanol produced per year, and it really accounts for 0.5% of all CO2 emissions just from this one chemical. And how we make it is it's a mixture of syngas, so carbon monoxide, and hydrogen that we get through a process called steam methane reforming. We heat that up at high temperature and high pressure to produce the methanol, and then there's some downstream refining. The opportunity, and there's several different ways you can do this from I would say like green or a decarbonized fashion. And one is really taking CO2 and hydrogen. So you would want a hydrogen source that is not made from steam methane reforming. So whether it's green hydrogen, so from water electrolysis, it's yellow hydrogen, pink hydrogen, lots of different colors of these days. But you want a decarbonized hydrogen source and taking a CO2 molecule, and then you can reform those and then produce your methanol and then also water. And so I'm going a little, there we go. And so showing what this could look like. So the hydrogen, you're going to have some hydrogen generation technology, as I mentioned, different sources there. And then to produce that decarbonized hydrogen molecule, and then from a CO2 perspective, you can imagine direct air capture or point source capture. And from there, your input and your feedstock here is your air. I've put a system boundary here, which is this dash line. And that's really, we'll get to the heart of that in just one second, but it's essentially looking at your two feedstocks at a very simple model of putting that into your methanol loop for a thermochemical process. So, temperature and pressure ranges here and below, and you're going to run this reaction to produce your e-methanol, your decarbonized methanol. And if we're using a DAC source for CO2 and green hydrogen, where the hydrogen electrolyzer is tied to a renewable source, your reduction in your CO2 is massive, and so the opportunity is really great. One of the big things to keep in mind always in a TEA here is like what your system boundary is. And this is maybe one of the things I got on one of the last slide that will come through is just making sure that your system boundary really encompasses the inputs that you need and the balance the system around your core technology to be a fully, I would say, fully developed cost model. And as the technical roadmap it gets more developed, the system boundary and I would say the sensitivities to the different inputs become the fidelity of those numbers will also become greater. And so in that system boundary, what you're thinking through is like, what capital cost do I need to consider? So of course you're going to have your methanol reactor, which is going to be some high temperature, relative, well, I'd say medium temperature, medium pressure reactor in this case, your balance of plant here. So all the pumps, all the cooling, the piping, the distillation, the tanks. So there's not just inputs, a reactor, and then you've got methanol that can be sold downstream. You really need to think through like who you're at the source of, like you're the off taker of some feedstock coming into your process and you're selling your product into some market, and what is their spec and and what are you going to deliver to, because then you will need to ensure that your TEA encompasses that full system boundary. Your OpEx here, so feedstock costs, your CO2 and hydrogen, energy, operations, O&M and maintenance, consumables. So even again, in the spirit of doing a 20-liner, you can get smart very quickly here on what will be the important things that your technical team should be focused on. And so here's, I didn't count the lines, but let's say it's something maybe greater than 20 by eyeballing it, but it's roughly there. And so here's what I've done is said, okay, I've got my inputs on the top and my outputs on the bottom. And so on your inputs, I said, here's my feedstock inputs. I've got a methanol yield of 50%, so hydrogen and CO2, put it in my reactor, and I get 50% methanol of my theoretical max. I put in an input and I hard coded in a CO2 feedstock cost at $200 per ton. Certainly can argue on what the right number there is. And likewise for hydrogen feedstock cost, I penciled in the $2 per kilo. And then you can see from on the right side, I'm saying like, where are the sources, or where would we be thinking about this, and how would a startup be thinking about this? And so certainly whatever cost you're putting for your feedstock needs to be based in the volume of feedstock that you want, and that cost will almost certainly be, if it's stack or point source, will be obvious in the dollar per ton that you're using. Likewise for your hydrogen price as well. The energy consumption piece is normally we're going to be asking that from the company. At a seed stage where you're just, at the bench, you're probably not going to have this, but that's where I would say thermodynamics are your friend. Give a thermodynamics, look at the thermodynamics, and then you'll be able to at least give a ballpark in terms of a floor, and then know what you're working towards. Electricity cost, I put 8 cents a kilowatt hour, fixed O&M, and then some CapEx. So here, this is maybe one of the hardest things for startups at the early stage to understand. And there's lots of different ways and tricks you can think through this, that you can, resource it from the company, look at literature, you can get quotes, look at comparable processes and understand where those come in. And ensure that when it's total installed, it's not just that reactor, it really is that full system boundary. You have the capital recovery factor, which really is amortizing your capital cost over a weighted average cost of capital in a timeline. And then your capacity factor essentially tells you your uptime. So using those inputs, I have my outputs, and what I'm looking for is like really my total cost of production, which is a key thing to keep in mind. This is not what you would sell at. This is what you're producing at. And so here I have almost $2 a kilo for methanol, And what I really want to look at and how I even think about it when I'm building and I build TEAs for a living is I look and say, what are the largest contributors? So if we look at our capital costs, you can see that they're about 37 cents contributing, and we just go 16 with electricity, our fixed O&M. But you really can see that your feedstock costs here are dominating. And that's not surprising to me, not least because I purposely put my yield here at 50%. And so the thing here is that what I would look at agnostically is if this was a company, let's say, and their unique selling point was on the catalyst development. So let's say the state of the art for methanol production, the yield was, let's say, 50%. And this catalyst company was like, I know I can get this at 95%. The first thing I would ask myself, well, is that even a big deal? And the answer to that would be yes in this case, because you can see that the amount of CO2 and hydrogen that I need is a function of, yes, it's something called stoichiometry for those that are a chemist, but it's also a function of yield. And so the yield is impacting these numbers greatly because you need per kilo of methanol that you want to produce. If your yield is less, you need more feedstock to produce that same kilo. And so if this company were coming to me and I would say big market, big decarbonization potential, and they're a catalyst company and the state of the art is only 50% and they can do something better, then I have a really great shot at lowering the cost, my total cost. And the other big thing to keep in mind is, again, I mentioned this is a production cost, and really you're always wanting to benchmark that to what is like that gray technology selling cost. So in the market, gray methanol is somewhere, but depending on region and geography, but I would say free on board, it's around can be $300 to $500 a ton, and so really what you're looking for is like what margin you would want to your company to make in order to compare to sell at that same without a green premium. And so thinking through the same economics, I now change my yield to 95% because this methanol company has an amazing catalyst technology with really strong IP, and they've got a very strong roadmap to get from that 50 to 95%. I see that I had made a large difference in my total cost of production, and that it was purely just a function of that one metric, and that's because my feedstock costs went down. And so this would be a really good example of if this company were to come in and let's say they were focused on some balance of system design or some heat integration piece that would lower their electricity consumption from 2 kilowatt hours electric per kilo of methanol, let's say to 1 kilowatt hour. You can look right at the TEA and say that's probably not the best. While it's an incremental change and that is always good, we'll take it. It might not be the best use of the technical team, just because the opportunity cost of time is high for venture-backed startups, and because 16 cents a kilo is not the major sensitivity in this model, it was feedstock. And so it would be less, I would say, it would beg the question if that's the right technical metric to focus on as electricity consumption, as opposed to again this yield piece that we mentioned. Again, this is all hypothetical. The methanol yield is much higher than 50% for thermochemical processes. And so the last slide here is these are some of our do's and don'ts that we think through internally and that we see across techno-economic models. The number one I have here is on unreasonable assumptions. This is one that I would say less. Maybe I'm not sure what the cause is there, but there certainly is a I would say tendency to think that we're going to for an electrified process to pencil in 2 cents a kilowatt hour at a 30% capacity factor. And the reason that is wrong is because if you're telling me your capacity factor, and remember that's the uptime is 30%, you already pretty much told me you're tethered your technology to a renewable source, so either wind or solar and batteries. And so if you're going to do something that's in renewables, because it's that capacity factor, the 2 cents a kilowatt hour is really low. And there's not that many opportunities to really access 2 cents a kilowatt hour. Doesn't mean there's not pockets where there's 2 cents available. But when we think about world scale or even, domestically US scale, I would say that really benchmarking your electricity prices to what current industrial prices are is something that would be important. I think it's really appropriate to use ranges so you can certainly show that sensitivity if it is one in your model and show where and how you think you would get to 2 cents a kilowatt hour. And that's absolutely also valid. The second thing is the system boundary. This is one that we see often is not modeling the key costs associated with making your widget. So again, in that example of methanol, if you had your model where the inputs and it was just that one reactor, and then you that magical reactor can just produce methanol on spec without any further downstream processing, that would be remarkable, but that certainly does need some processing. The apples to oranges, comparing your cost to a selling price or an outdated target, this is something that I would just be mindful of. I mentioned it earlier. Often, when you get a production cost for your technology and then you compare it to the selling cost in the market, that is not the market's production cost. That is, they are making money on that because they are selling it. And so just make sure you're comparing your production cost to a production cost. We've talked a little bit about focusing on the wrong metric. That's what I mentioned earlier. If you're focused on the energy consumption piece of that thermochemical process and energy was not a sensitivity, it might alert you to focusing that the real issue there on and the fictitious example I provided was on catalyst development. And then false position is what I mentioned earlier is that you don't have to know it all this early stage. Just know your big levers. I really do believe that a 10 liner can get you so far down on what you should be focused on at the early stage of development. And you don't want to go down the road of having multiple worksheets with multiple valves calculated at a seed stage. You just you really don't know yet. And I think that's okay. And we think that's okay, but just being mindful that you don't want to convince yourself of maybe what you think the problem is with that much fidelity that early. So I think I'll pause there. I think that was the last like perfect, and happy to answer any questions, EIP, the fund, on techno-economics, whatever is helpful.
That was great. Thanks, Dr. Paul. Um, I'd like to read you a few questions, if I might. There are quite a few that are piling up here in the Q&A queue. So, from Phil, he asks, "How can you quantify a benefit which is almost unknown today, but will be critical in the near future, say in 20 years? For example, direct atmospheric cooling via DMS produced by phytoplankton."
Yeah, I'd have to know way more about that technology to comment on that technology. But if I understand the question right, it's that right now, is it more of like there's not a market yet for this, but we know that we're going to need it in the future. So how do you value a technology's benefit when right now it's not actually valued or there's not a best available technology for it? Am I interpreting that correctly?
I would guess so.
Yeah, I think so. My feeling, and I can see if I can stop sharing here. Yeah. Um, cool. I think when we think about that, I think it's one of these where it's really, you could think of a lot of things like there's geoengineering in the example that this listener just provided. I think it's a hard challenge trying to convince. It's a hard challenge doing anything that we're all doing, honestly, in the clean tech space and competing with fossil based technologies. And so then it's going to be an extra hard challenge. And then if you need to convince somebody that this is going to be a valuable and so what I would try a valuable technology or why they're gonna need it. And so I guess I would just start at like the first principles is what value is it going to deliver and try and tie that to a real quantitative number of what this value is and what this can mean. I think there you're going to want to try and show commercial traction. It's going to actually expand beyond technical. Like who's going to want to be the buyer for this and the why. But how investments are made and certainly how commercialization is moved is really understanding the unique value prop. So there must be a way in that particular case to at least say what this will do from first principles, whether it's thermodynamics, it's a comparable technology, and say what the potential benefit is. And then I think the hard work beyond that is going to be convincing people if it's not already valued today, why they would need it now. And so hopefully that's helpful. Sorry, can't say more without knowing a bit more about the tech.
Yeah, that's definitely an out there question far in the future. But James Stewart asks, how many inputs and variations, permutations in the range of input costs is sufficient in a techno-economic analysis?
Great question. Uh, I think a tornado chart goes a long way. And I would say the way we like to think about tornado charts is so you'll have your base case. I should also say this when we're doing TEAs, I mentioned it in one of the slides where you are today and where you're going to be are very different. We're not making investment decisions, and I don't think most are based off where techno economics are today. It really is the pathway of where you will be. And so, what we will often do is, a startup will give their TEA, or if they don't have one, we're going to make our own internally. And then what we're going to end up doing is we're going to make a tornado chart and we're going to choose boundary conditions. So I would say you don't need to go find every single permutation that will be a waste of your time. What you're going to want to try to do is actually break your own model because that's what we're going to try and do. And so a good example is let's say you have a process that has a commodity, let's say it's copper, and let's say you tell me that copper is a feedstock, so i.e. lower copper prices would be good for you. And so you tell me that your copper price is $5,000 a ton. And I know the market LME price is around $9,000 a ton. And I think the future price might be 10 to 12 based off our copper. I'll put your downside case at $12, sorry, $12,000 a ton. And I'll put your base case somewhere in the middle, and I might put your bull case where it depends what they say on their base cases. And so we would do a range that way. So maybe three is the right answer. And the goal is to say, if everything went right, how would it affect you? If and then we look at our own forecast for those downside cases and upside cases, and then we'll use your base case somewhere in there. So just try and break your own model, but don't try and do a Monte Carlo simulation on like a billion different cases that could be.
Great. So Shane Namtice and James Stewart teamed up on this question and they said, are there any examples of software enablement startups doing a TEA? And then James chimed in with, how is the TEA different for a SaaS company that delivers decarbonization, for example, greenpilotlabs.com?
Yeah, on the first one, I believe there actually are now, and I've been approached by a couple different folks on this that they have a software-enabled techno-economic model and I'm not sure on the customization on this, but if I like, I've actually done a couple of trials, but certainly in some of the more standard, I would say like standard is probably the wrong word, but whether it's a known technology, where there's multiple startups working in that space and there's multiple inputs, I've seen that, seen a couple of different folks do that. On the SaaS piece, in our fund, we are a hard tech investor, so we don't actually we will do a software play when it is with hardware in our first fund. But we don't have a pure software play. And so I think it would be quite different in that. And I think your metrics that you're going to be designing to are also going to be quite different. So I'm sorry, I don't feel comfortable commenting on that one.
Okay, great. Well, here's one that got a lot of upvotes from Warren and Louvu. How do you think about building TEAs when you're using it to evaluate multiple technologies? My context is that I am evaluating different formulations which have different inputs, but the reactive material in the formulation impacts the manufacturing process. How does it make more sense to build one sheet with each technology as a separate column or to build separate sheets for each?
It's a great question. I think you can do it either way, but there's two things that come to mind. I certainly we have it even in our own portfolio, and I've definitely had to build this where it's like, let's say you've got a chemistry that has five different components, and essentially the mass fraction of those different components can affect your cost and then your production cost. You could just make it where it's toggable. So in your inputs, what I would do is I would have each formulation as an input. And that way, if it's building into, let's say it's A, B, and C, and A plus B plus C, and you do the mass fraction of those equals your product, it's then your product formulation as an output. And that way you can easily change those different parameters and it will give you a different product, it's like cost output. And then Excel or a lot, I'm sure other programs, but Excel, you can just sensitize it. So there's ways in Excel to build sensitivity tables and that it can be automated, especially if you make them independent. So the key there is to make each of those components independent and then use the solve function in Excel or use a sensitivity table in Excel, and it will allow you to build out the formulations that you're looking for.
That's a great tip. From Shadi Darvish, he says, our core focus is TEA for clean fuels and decarbonization. I'm curious, how do you usually factor in policy risk, like changing incentives or carbon credit values, when reviewing a startup's TEA?
Yeah, it's a great question. This one's really highly dependent on the technology and the geography. And so this is one that we've seen certainly this year where I've had to think a bit more about that. So whether it's, the US and the US policy here for clean fuels versus Europe, and SAF is a great example, or we can look at hydrogen's another great example, and how geographies have approached their policy with clean fuels is really different. So the US had more of a carrot approach with the ITC, and Europe certainly had more of the stick approach with just more on being penalized if you don't actually have the supply, or sorry, have the demand, and procure in the clean fuel, even if the supply is not there. And so I think both sides of the policy angle probably it's so hard to put that into a TEA. I would say our conviction on the policy is like it goes way beyond a model. If it's a hard coded tax policy that has both in all sides of the aisles that are proponents, it's relatively easy. I would say right now is a tricky time, and I don't know if anyone has the secrets there in terms of how to really put that in. So I would put that as a downside case, honestly, what we were saying earlier. So without tax policy, have that as your downside case. With the tax policy, have that as your upside case. Build your tornado chart. And that way, if you're pitching to a startup, you can show them where the risk is, because it's certainly a risk and we should try and price it in. And I would say just be mindful of those policy decisions, whether it's Europe or it's America, because it certainly can be different. And the lens that investors are looking at can also be different. It's
Great.
a great question.
Then here's one. You touched on this, but it's a little more pointed this time. How do you quantify realistic prices of commodities that you either consume or produce at your company?
Yeah, it's a great one, because I made the comment around, like, low volumes. So it really depends on the commodity, but like, I will go to, like, everything from you can do your whether it's an AI source or your quick Google search to then go into large commodity providers. So in the case of methanol, there are large OEMs that produce methanol. You can go into their 10Ks or 10Qs and go look and see what their average selling price is. You can do some like financial engineering to go and actually figure it out. You can try and talk to people that are at those, a lot of those like, commodity chemical, if it's a commodity chemical or commodity in general, lots of those different large corporates have venture capital arms that like to find technologies. And so you might get in front of them and stress test some of your assumptions with them. I think you can always also with an investor that is pricing these things and cares about TEA, you can always ask the question. Like, I've certainly been on many calls where someone says, I assumed X amount per kilowatt hour for this. What do you think? Or so, what do you think is fair? I think that that is also fine. And when in doubt, just use ranges, because that shows us and shows others and yourself, like, where your limits are. And that is genuinely what you're trying to do. It's not just, I mean, of course, startups need funding, and it's a hugely important part, but it's really about your own company and it's about knowing your own limits. If you do ranges and you know what you need to believe, I think that will go a long way.
Let me just follow up on that question myself. If how much as an investor, how much volatility would you tolerate in a TEA when you're thinking about an end product where the price might, move around a lot over time?
Yeah, I think it's going to depend on what that and so let's say you're making a commodity. So let's say you're making, I'm going to say rare earths. Let's say somehow you've got a technology that can make neodymium. wonderful. And that's me. And we're going to ignore all the policy support right now when I in this answer, because so maybe it could be a bad one. But neodymium and rare earth pricing is a function of not having a domestic supply chain has been quite volatile, right? And so what we would always do, what we've done in the past, and certainly in rare earths, is go and get the 10-year low and the 10-year high, and then try and again truncate that from that perspective. I would say largely the seed, pre-seed, Series A, Series B, the amount of uncertainty is really high, and so boundary conditions are really, I would say, the key learning I've had at EIP is of how can I take something really complex and really volatile and find a boundary condition and get comfortable there? Because if you can get comfortable at the boundary, then working your way inwards is much easier. And so I think we would look at the rare earth case, and yes, there's been lots of volatility, and we would ask ourselves our conviction on that end product. So, rare earths is a good case there. My conviction on rare earths is very high. We're an energy investor, so we care lots about electrification and robotics, and so rare earths are obviously hugely important there, as in also in defense and other industries. And so we have high conviction on the end market, and the end market is really big. And then I think you could then try and back out in terms of if you're a financial investor and you're looking at returns, you can try and see where that technology, where, again, where those boundaries would be.
Great. So here's one that's directed at EIP. Does EIP invest in robotics? And if so, how would the techno-economic analysis work in that category?
Yeah, no, definitely. We invest in robotics in our first portfolio. There's a couple of robotics plays that we both have announced. So Charge Robotics is in our portfolio, and then Asset Cool is also in our portfolio. And so we definitely do and have and will in the future. And so it works just like every other robotics. There's a couple of other metrics that will matter. So certainly there's going to be capex, but there's also just going to be about I would say all your OpEx, your CapEx, and then you're really going to be looking at the lifetime of the robot. And then I would say the if it's a robot that does something where it's coding conductors like it does with Asset Cool, we're going to be looking about how fast it can traverse those lines, and because you're going to be building into something called productivity, so like lines per day, and so that
Right. Are you there, Melissa? Yeah. Are you there, Melissa?
yeah, right here.
Okay, great. So what notable technologies consistently are not meeting your TEA thresholds? That's from Melissa Bergen.
Oh man, that's a hard one. Let's see. Look, there's this. I was trying to say not controversial today. I would say there the way I'm going to rephrase this question, yeah, or my answer is that how about technologies where it's really hard to meet the gray technology? And so, an example there, a lot in fuels can be in this case, and the reason is that fossil based fuels are so dirt cheap. The feedstock is so cheap, and that's why I always love a fuel example when I'm doing these, because I in that example, it's actually true that your feedstock is your largest cost. My hyperbolic example was trying to show that even more. But when you're competing with a fossil-based fuel that has a really cheap feedstock, so methane or coal, and then our feedstocks are much more expensive, right? So decarbonized feedstocks like CO2, or if you're making a decarbonized syngas, or it's going to be some decarbonized hydrogen, it's really hard to have the techno-economics be on par with that gray technology. Is what I would say. Don't Wouldn't say it's impossible for clean fuels. Clearly, it's not impossible at all for clean fuels. But I would say that's just one where the unfortunate, or I would say another one's like highly commoditized. So in like steel or cement, those are also really difficult ones. So anything where you have electricity prices where they're very high, or you've got a technology that just has dirt cheap feedstocks. It's really difficult. But there's amazing founders in those spaces that are making those techno economics not just work, but be very investable and exciting. So I would say that those teams focus on the right problems and solve those right problems and prioritize them for impact.
Got it. Okay. Michael Barrow asks, how do you account for butterfly effect values stemming from deployment. We leverage drones to rewrite hands on work on the grid. And one use case is accelerating smart grid sensor deployment. Would you layer in accelerating DLR deployment on the value of this technology's TEA?
No, I would say the TEA is gonna be fundamental and like what your cost to value is, then the value piece for sure. If you're an enabler of a technology that we have high conviction on, it's not gonna necessarily be an input into a TEA, but it's certainly gonna be an input to an investment decision. So we see lots of those things. And so I think enabler technologies are very much in scope for lots of venture capital firms and it can be really, really exciting. And so if your particular technology has a component where it really can enable DLR, then I think that's the value that's exciting. And I think that the thing that an investor will be thinking through is their own conviction on that. So is this, and so it's not only your market and your techno-economics are going to be evaluating, they're going to be evaluating that. And if that's the key enabler, then they're going to be evaluating their own conviction on that. So you need both to be true for an investment decision there. Because I guess the way to put it is, like, are you controlling your own destiny? If your destiny is uh, is really tied to DLR, or any other whatever downstream technology, then you're asking. It would be like a two-part decision if that makes sense.
Great. David Pryor Hope asks, for our TEA, we have modeled a number of technologies with different levels of technical uncertainty. And then in parens adds, the less certain technologies are the cheapest. How do you recommend presenting these models whilst presenting the levels of uncertainty?
I mean, I'd have to see the output to probably be more specific, but I would say basically it seems like there's uncertainty bounds across a couple different technologies, and the questions around how do you present that to an investor to show value of your own technology.
Okay, got it. And Lakba Sherpa asks, how do we integrate market adoption rates into TEA? And then she adds or he adds in parens, learning by doing, regulation driven demand.
Yeah, I would say that the adoption rate wouldn't be in your techno-economics. Your techno-economics is purely going to show you that literally the technical metrics that matter for your economics and your production costs. Where your ramp rates and your market adoption will come in is your financial model, which the TEA would be a component in your financial model. So let's say your COGS are tied to your techno-economics, that's your cost of production. And then you would have, let's say, your revenue generation is going to be a function of that adoption. So I would just haircut your revenue assumptions based off your adoption. And certainly investors will be looking at that. It's a great question, and they'll be looking at the haircut you applied and asking themselves, do they need to do more?
Got it. John DeLapp asks, how detailed is the typical TEA? Algorithmic or physics based? Also, what metrics resonate the most? IRR, NPV, break even, LCOE?
Um,
That's
how
too,
detailed it can be will depend.
yeah,
Yeah,
I get.
it'll depend on. I'm sorry. Did I interrupt you?
No, sorry. I was just saying it's really two questions. How detailed is the typical TEA, algorithmics or physics based? And then separately, they ask what metrics resonate the most.
The TEA depth it is so variable depending on the company. We will see 10 liners and we will see multi worksheets. And that was where that cautionary tale, depending on your stage, came in. I find it's like, in particular on capital costs and system level boundaries, at an early stage, it's near impossible to have that level of detail and fidelity on that level of detail that early. And so, everything, I would say, again, like, I would turn it around on the startup, like, the TEA is not just a tool to get funding, it's a tool to help your team focus on the right problem. So whatever level of detail you need to ensure that you're focused on the right problems, I would design to that. And on what metrics resonate the most, every one of the ones that they just mentioned. So NPV, IRR, LCOE, if it is an LCOE type technology, but essentially all metrics that are going to either make or break the technology from an economic perspective are the ones we would be looking at.
Okay. Michael Yin asks, is there a list of techno-economic analyses or journals that have the list? I'm not sure if that one makes sense, but maybe you can be a good judge of that.
Yeah, I know there's definitely in the literature, so you can in a lot like clean fuels is a good case. There's a lot of really good academic papers where they will have done if you put like techno-economic analysis of ammonia in Google Scholar, you'll see how it might not be your field, but you'll see how others approached a problem. And I learned a lot myself from that, to be honest. So I would definitely recommend that. And then I think Activate, I believe they have a tool, an online tool on their website, at least for starters. But really it's as simple as like what are the inputs and the key outputs and asking yourself those questions and building a simple model off that. But I would certainly technical based startup, the technical team for better for worse has probably read a lot of academic papers, and so they'll be very good at literature searches and finding papers where others maybe in a similar discipline or the same discipline have written a manuscript with TEA and then look at the supplementary information and you can see how they built things and it is really helpful.
Great. We're down to our final two questions. This is quite a marathon. Thank you for tearing through them so quickly. Where has uh, where has your been least effective in influencing investment? Yeah.
I don't think it's not been I mean, I think our team works so closely with our deal leads. So I would say that it's always if we always learn something. So I don't know if it's not been effective in any case. If it's something, there's many reasons you make an investment, right? And so there could be an example where we make an investment that's purely nothing to do. Well, actually, I don't think that's true. It's always going to be about the technology. It's always helpful. We always make it. We always learn from it and, I think that there's many cases where it's made us not making an investment, and there's many cases where it's made us make an investment.
Okay, great. And David Pryor Hope, actually, we've got two more, one more snuck in. David Pryor Hope, at the seed stage, do you advise the CTO, CSO to make the TEA or commission an external company? If you feel the TEA should be made in house, how do you advise fact checking it?
That's a great question. We see both. My personal view, I don't think there's a right or a wrong. I think it's always about opportunity cost of time. I'm a learner by doer, so I like to make things. That's how I learn the most. I would say if you outsource it, I would think it's very important that your technical team is working with that consultant. There's lots of consultants that do this freelance for what it's worth. And so certainly you could work with that person, but I would say really as a partnership, not as an outsourced model. Because again, the goal is that it's helpful to the technical team. And so I think ownership over that is really important. So yeah, I don't think there's a wrong way. My personal views, I think it's better to be made internally, potentially, but I think that there's a lot of consultants that have done this in the past. They're wonderful, and then just work really closely with them.
Great, great. And Michael Barrow asks, I know DOE provides technical assistance and TEA to private companies. Have you ever seen them provide that to startups as a gold standard sort of TEA?
I have not. I have not seen that from the DOE. Doesn't mean that it doesn't exist. It's not something I know if you apply to the RPE program, and I know that if you're one of the recipients of an award and you've got your program manager, I know they're amazing, they're very hands-on, and certainly I think that they would help a startup in every way they can, not least in their techno-economics, but I haven't seen that. As I said, there's a couple of firms I know, and I do know lots of or a handful of consultants that actually work independently to help startups who have been part of startups before, and so they know what startup life is like, and they know how to model very well, and then they work directly with startups too.
Great, great. Well, we've gone through a lot of questions. Thank you so much for your time today, Dr. Ball. I think our audience, which was quite a big group, well over 200 at peak, got a lot out of the past 50 minutes or so. So thanks again for joining us for the second time at the fifth annual SOSV Climate Tech Summit. Someone asked if they could have your slides. Would you be willing to share those with us and we could pass them along? Okay.
Sure, I will definitely let me check with the EI compliance team, but certainly, we can I will do that as an action item, and thank you for asking, that's very flattering, and always happy to talk about this topic. Very excited to be here for the second time as well. Thank you all very much.